Welcome to our monthly market insight. Sean and I will talk a little bit about what's been happening specifically in September before we get into our outlook as we approach fourth quarter. So, Sean, it's been a crazy month, right? Specifically in terms of market performance. Last week, the last couple of weeks, the markets have been reacting to just things that are going on in the media, legislative decisions in terms of raising taxes for some, measures in terms of funding the government and raising the debt ceiling. So Sean, tell us, everyone that's listening, kind of what we're monitoring, what our outlook has been, and how that may impact investor strategy.
Yeah, so there's no doubt that September lived up to its name historically, just kind of tends to underperform the market just kind of randomly. But a lot of that is because at the end of the government's fiscal year, which is September 30th, there's a lot of kind of uncertainty. And, we're certainly feeling that now with the government kind of being forced to raise the debt service ceiling limit right now, and also trying to push forth some infrastructure bills in terms of $1 trillion measure, then potentially another 3.5 trillion. So all that leads to a lot of governmental regulative kind of pressures and uncertainty for the markets, and the markets just don't like uncertainty. We've seen things like raising taxes and getting rid of some tax benefits and raising corporate taxes, and all of these measures and discussions just create uncertainty. So I think we're seeing a lot of that just kind of right now in the market. All that being said, through October 1st of this year, the S&P 500 is still up 16% for the year. And the NASDAQ is up over 13% for the year. So that will, based on about noon today, those things are changing a little bit. But overall, it's still been an extremely, extremely positive year. And so we're starting to see just some uncertainty kicking in. And one of the things that we're really watching is kind of I sound like a beaten drum right now, but is inflation. So inflation for the last 12 months has been about 5.3%. It was 5.4% the last 2 months. And so as we see inflation stay steady, yet still a lot higher, about 3 percentage points higher than what the Fed has as an average target, we are making sure that clients have got their money invested in the market. If you got money sitting in a savings account, you're going to be losing out. You are losing money to inflation every single day. And there's really no sign that that is going to go away. We heard the Costco CEO come out last week and say that based on their earnings call, they expect inflation, unable to get nuts, oils, coffee, unable to get those things produced. There's just a kind of supply shortage based on workers, based on a lot of things. And so they're passing off some of those higher costs to the consumer. That is inflation, right, at the simplest form. And so we don't think that's going to be going away anytime soon. So the best thing we can do is get your money invested in the market. Don't be sitting on cash.
John, we kind of talked about all the things that the media is talking about, all these, bills that are trying to be passed by Congress, infrastructure bills, trillions of dollars. One of the things I know that has been a topic of conversation with some clients is the backdoor Roth, in talks that Congress is going to ban those for high income earners. Talk to us a little bit about, if you're not even aware of what a backdoor Roth or if that option is available for you, and talk to us a little bit about what that mega backdoor Roth option is. Sure.
So, one of the things that we do with our clients is in the fourth quarter, we always want to meet with them about taxes, because taxes change, right? So, we could talk about the backdoor Roth IRA potentially going away, because it's one of the things that's being put forth in the bills that are going through Congress. But ultimately, we know that tax laws change all the time. So we want to meet with our clients in the fourth quarter, just make sure they're aware of kind of updates for next year and things they can do this year to kind of lower their tax bill. And one of the things that we typically do with kind of high income earners is the backdoor Roth IRA. So for people that are single filers, if they make over $140,000, they're unable to contribute to a Roth IRA. However, there's no income limit to the amount that you can put into a traditional IRA. So what we do is we put the maximum amount in there, either 6,000 or 7,000, into that Roth IRA. And then the next day we convert it to a Roth IRA, because there's a tax loophole that says there's no income limitation for the amount that you can convert to Roth IRA. So that's a backdoor Roth IRA in kind of its simplest form. That number is $208,000 for married couple filing jointly, or like I said, $140,000 for single filers. So we take a look at those things fourth quarter, say, is there a way that we can kind of put some money so they can grow tax-free? Because the power of the Roth IRA is that that money grows tax-free. The other option, which is very, very nuanced, would be a mega backdoor Roth IRA. And those are for people who have employers that allow them to make after-tax contributions to their 401k. So they put in the maximum for the 401k, 19.5 or 26, depending on their age for this year. And then their employer may put in a match. And there's usually some money left over. And sometimes the 401k plan will allow people to make after-tax contributions. So we make that contribution. And then the 401k plan also has to allow you to take in-service distributions before age 59 and a half. So there are not a lot of 401k plans that allow that, but it is a way that we could potentially get up to $38,000 funded into a Roth IRA in a year by converting that money over. It's just very, very few people it applies to. However, that Roth IRA, the backdoor Roth IRA, really applies to anyone, no matter what their 401k plan provides. So we do a lot more of those here in this fourth quarter. But ultimately, right, you should have a good tax plan in place, making sure you're taking advantage of 401ks, IRAs, backdoor Roth IRAs, whatever it may be, so you limit your tax liability for 2021. And we're going to need a lot of those things here moving forward because there are a lot of proposed changes going through Congress right now.
Okay, thanks, Sean. And as Sean mentioned, fourth quarter, we typically tackle that topic with clients, taxes in the fourth quarter. And so we all know tax laws always change. We're here to help, certainly not accountants, but that's one thing that we do for clients is put a good strategy in place. So if you have questions about a good strategy for you, just reach out to us. One of the other things that we did want to remind people that are either on this webinar or watching live via Facebook is Medicare. So those that are 65 and older, or if you're approaching 65, fall open enrollment is this month, October 15th. So if you take a look at your Medicare plan and see a gap in coverage or things need to change, just know that that open enrollment starts October 15th to be effective January 1st of 2022. So that's kind of the thing, the topics that come across our meetings with clients, things that we're hearing people talk about. Sean, anything else that I'm missing that we need to add?
Yeah, I think the one other thing that's kind of been kind of more recent in the news is the rising yields. So what we see is the 10-year Treasury kind of is a good barometer for mortgage rates, loans from companies, things like that. We're starting to see rising yields. And so that will be more of a discussion and thing that we're monitoring here over the next couple of months. And the reason that's important is usually that's a good sign for the economy, right? So the yields rise for the Treasury notes because people say, you know what, I want to take on more risk. I'd like to be in equities. I'd like to buy corporate bonds, whatever it may be. So I'm going to sell some of my safe money, some of my safe Treasury money, and get it invested in the market. And that causes the yields to rise. So again, another thing that we're monitoring is it could be a sign that even though we've got a lot of change, a lot of volatility in the market right now, that things are still looking good. And I think a big key point of all this is just because there's uncertainty, just because there's volatility, doesn't mean you need to run to cash. It doesn't mean that you need to panic. It means you need to make sure you trust your plan, develop a plan if you don't have one, put a good tax plan in place, and then go enjoy your life and your family, knowing that you've got people that are there to help you through those turbulent times.
Okay. I appreciate it. We'll talk to everybody in November. Have a great October.
Thanks, guys.